Hey guys, welcome back to the Hilton True Wealth Podcast, the show where we explore the ideas, strategies, and conversations that help people build meaningful, lasting wealth, not just financially, but in life. I'm Mark Miller, Managing Director of the Hilton Family Office and CEO of Hilton Tax and Wealth. For 40 years, I've been helping people grow their wealth in many different ways. So today we're going to tackle how to pay zero taxes. Seriously. So let's talk first about the main things we'll be discussing today. Why taxes are the largest lifetime expense most people will ever pay, and that includes you too. The difference between tax preparation and tax planning. What are those differences and why is that so important? How the wealthy legally structure their finances to reduce taxes. We're going to talk about strategies associated with that. You know, this is our kind of philosophy at Hilton. We're going to bring the wealthiest of the wealthy strategies down to Main Street. And it just so happens that the Hiltons happen to be some of the best at mitigating taxes in the industry. So the biggest tax mistake that high earners make is thinking that their CPA is going to help them save as much as they possibly can on their taxes. So most CPAs are looking backward. So they're really what we call historians. True tax planning focuses on a design that we look out maybe the next, say, 5 or 10 years. We put strategies together that can seriously, like I started this off with, save you enough money to where we can gradually get to a zero tax bracket. Most wealthy people are in that bracket. Now, by the way, I want to address this whole issue of, well, that means that the wealthy aren't paying their fair share. That's not the case at all. Generally, the wealthy, if they own a lot of businesses or something, they're paying way more than their fair share to what they're producing in the economy. Plus, even if someone doesn't pay taxes, if they get to a zero tax bracket in the federal bracket, well, then generally they're paying all the other taxes, sales taxes, property taxes. I mean, the list goes on. And people that are very wealthy pay a lot of those taxes alone because they're spending a lot of money, obviously. So I'm also going to talk about why April 15th planning and looking at April 15th as that's the time when you're doing your taxes and you're saving on your taxes. Well, that's already too late. And there's a real difference between compliance and compliance CPAs, that they're just doing taxes and tax preparation, and strategic tax architects at what we call proactive tax planners in our companies. So the main thing is that we find is most high earners are at minimum paying $30,000 more than they need to. So they're overpaying on their taxes and they don't even know it. And the other thing is also, why are doctors, executives, business owners, they're sitting in the highest tax brackets unnecessarily, and how to fix that? Especially if you're an executive or a doctor that's a W-2 employee, because there's very few ways to save money in your taxes. They have no exposure to that, and most CPAs have no way of handling those tax situations. So I'm going to talk about the tax playbook of the ultra wealthy. And this is really kind of how the smart money reduces taxes. So here are the key points in this. First of all, the wealthy focus on tax-free income streams. Now, what I'm saying here is specifically when you talk about investments, they're focusing on structuring all their best investments to throw out as much tax-free income as possible. So it makes it very easy for them to pay very little taxes because all the income they're getting is completely tax-free, obviously. There's three kind of strategic tax planning buckets. First of all, there's the taxable bucket that you have. the tax deferred buckets you have, and then the tax free bucket. Of course, what we want to do, and we work with all our clients to move as much of all their money into that tax free bucket as possible. Now, specifically, I'm talking about investments. About designing, putting investments in your portfolio that just automatically do that. Also, diversification is very important because, and it is for investing, it also is for tax diversification. So, of different ways and different buckets of money and types of money, and different ways you're paying less taxes too. So, the other thing is institutional or really good investors and money managers, they plan decades ahead for all of these tax specifics. So here's some examples of advanced kind of investment strategies. Advanced, I don't know if I go that far because some of you probably heard of them, but we can talk about them further. First of all, are Roth conversions. And everyone's heard about that. Now, here's a funny thing about Roth conversions. Most people don't want to do them because if you do them, the IRS comes knocking at your door right away and says, hey, you just converted all your tax. So we want all that money, all that tax money up front. So that scares most people away. Now, in the long run, it still pays off. Now, one of the things that we do with Hilton Tax and Wealth Advisors is we structure things to make the money that you would have paid for that conversion completely tax-free or as much tax-free as we possibly can. So then it makes the conversion really easy to do. Tax-advantaged insurance structures. I won't go into those details on this video because we don't have enough time. But the bottom line is that there are specialized insurance structures you can set up to save a lot of money on taxes, and a lot of wealthy people use those. Strategic income timing. When are you going to take this income? Now, that's not just about tax deferred income, but that's all types of income, including like capital gains planning ahead of time. When are we going to take that to structure on an annual basis to what the taxes are going to actually look like? And a tax plan, a good tax plan, again, is looking down the road, looking 2 or 3 years down the road too. So the goal, one of the things, and here's just a quick Hilton thing, is the goal isn't just making money, it's also keeping more of it. And when you look at the wealthiest people in the world, that they're generally figuring out ways to pay less and less taxes because every dollar that they can save, it means more money back into building their wealth, obviously. So let's talk a little bit about some advanced tax planning strategies for business owners. And really what this is doing is kind of turning the tax code into a wealth tool for you. There's several different ways. We can look at the tax code, private letter rulings, case filings, all of those things, which, by the way, usually most CPAs, and I could venture to say 95% of the people listening to this, their CPA is one of the 95% of CPAs that are just giving you the basics. They're like, hey, put more money in a 401k or an IRA, make sure you got the right business structure, or make sure don't miss your home interest deduction, things like that, which are basic things. Some of those actually, to tell you the truth, really aren't even in the code specifically, but they're on the forms that you can use on the forms, which is really strange. But those are just the basics. So the neat thing about it, the tax codes are really written to reward business ownership and investment ownership, okay? Now, that does not mean that tax strategies are only for the wealthy. It just means that there's more of them. And why are there more of them? I'm going to give you a really simple answer to that. Because there's more money there. So there's more money to play with and work with. So obviously there needs to be more strategies. Business owners have access sometimes to strategies that employees don't. Okay, but doesn't mean that there aren't some strategies for employees too. We'll talk about those later. Examples to discuss: defined benefit plans, cost segregation, R&D credits, real estate depreciation, strategic compensation planning, income shifting strategies to change income inside your business or series of businesses that you have, or your business structure. Okay, so there are more options there, but generally, why is that? It's not just because they're rich and they get a special break. It's because there's more money there and there's more to work with. So there needs to be more codes and there's more structure inside of a business also. So we wrote a book with the Hilton Companies called The Tax-Free Business Owner, and you can go to our website, which is hiltonwealth.com, to get that book. And the funny thing is the majority of the people that we work with is that we can get to become tax-free business owners for sure. So, and because of the codes and the way that they're written, the codes are there actually to help us, not to hurt us. We realize the IRS is scary, and whenever you get a letter, even if they're asking, hey, we made an ad, or saying we made an address change, you open it up, you're still scared to open that letter from the IRS, right? Well, first of all, the IRS isn't as scary as you think they are. If you know what you're doing, you know how to properly work with them. There's a lot of processors, a lot of people in the IRS that are there to really help you and want to work with you to help you sort out all your taxes. So the code isn't a punishment system, but because of it, and honestly, the IRS has done some things in the past, and they still continue to do some things that make it seem that way, but it's really an incentive system. So how can you design, let's say, a tax-free retirement? Let's talk about that. So I believe that that's really the ultimate goal for, somebody that's got $1 million when they retire and some that's got $100 million when they retire, or even more, some of the clients that we work with. So most retirees are sitting on tax time bombs that they have no idea about in tax deferred investments, in 401ks and IRAs. I tend to believe, this is kind of a side story, when the original codes were set out, the IRS was really trying to focus on bringing as many incentives as possible to business owners to grow business, okay, when they were first set out. And then the consumers kind of came along, and then Congress got involved in the 70s and said, hey, let's give the consumers some tax incentives to invest over time, and then they can invest for themselves and then augment what we might have to do with Social Security long term, because the system's probably not gonna be able to withstand it, which they were right in that. Now, I tended to believe at the time, and I was even pretty young then, I didn't graduate from college till 86, which was a long time ago to a lot of you I know, but I was pretty young then. And when even I was young and kind of learning, my father was a financial consultant for a period of time and a banker. I remember there was this argument between kind of the Roth IRA folks and then the traditional IRA folks. Roth, by the way, was named after a very famous senator of the time that came up with the Roth IRA. And his argument was, hey, it's going to be better for the people. I've always used this example. If they pay taxes on the seed rather than the crop, which he was right. But ultimately, the lawmakers were swayed by the IRS. They won out because it was ultimately better for the federal governments, basically their tax revenues long term, to do the traditional IRAs. But the problem is it created a tax time bomb that has to be taken care of. And most people don't even want to take their required minimum distributions until they're 73 years old. Well, the whole idea of the system was, hey, when you're ready to retire at 60 or 65, you're going to have all this extra money that's going to augment your retirement that you can pull out of your IRAs. But the ironic thing is no one wants to do that, because then they pull the money out, then they jump up in their tax brackets and they're paying taxes, tons of taxes. By the way, in the codes, they put in there that when you pull money out of your IRA, it is taxed at the absolute highest rate that it can be taxed at. So it just didn't make any sense. So we're a big proponent, really, of the Roth IRA. I kind of believe that, my gosh, if back then they would have pushed everybody into Roth IRAs, by the way, people would have been investing in them. to a certain extent, it may not have been as much because that tax incentive was a big thing and has been a big thing. But I believe that, my gosh, people would be sitting on just mountains of wealth now that they would be able to draw out completely tax-free in their retirement. So, by the way, required minimum distributions are a big thing, and we need to address those. Again, that's a lot of times why we do a lot of Roth planning and try to get as much in the Roth or other type of proprietary products we use to get your money to where it's being thrown out of these tax-deferred accounts in a tax-free way. Future tax risk is important too. Often they say, well, you'll be in a lower bracket in your retirement. That's really not that true all the time, especially with a lot of the people that we're dealing with, especially if we work with them a long time and we've helped them build a pretty big bucket of wealth. Then if that's a lot of that is tax deferred, then there's going to be a lot of taxes due, and they could still be in the same tax bracket they were when they were working. Also, we're concerned about the impact of Social Security taxation, Medicare, penalties, and taxation. That's a big thing too. So all of those things we have to be concerned about in retirement. But how do we design? What do we do? What strategies do we use? Well, again, I mentioned Roth conversions, but what we're going to do is generally Roth conversion, what we call laddering, to where we're not going to take all of your IRA money or all of your 401k money and just immediately convert it to a Roth IRA. Tax-free income planning with your actual investments to structure the investments to work that way. So really, I talked about the different buckets. We want to go from that taxable and tax-deferred bucket. We want to move as much money over into that tax-free bucket that we possibly can. Asset location strategies, big deal too. Okay, so here's the thing. Building income streams you can't outlive is extremely important, and that the IRS also that cannot touch. And that's kind of the way that Hilton frames it and the way that Hilton looks at it. Okay. So what's the future of taxes? Let's talk about that. Why taxes are likely going higher and why it's more important than ever to do tax planning. And if you don't, 15, 20, 30 years from now, you're going to be in a really bad place. Obviously, we know a lot of this. Common sense tells us the U.S. national debt is massive. It continues to go up. Sooner or later, the piper is going to have to be paid on that. Now, there's some things going on at the highest levels to maybe try to convert that debt or whatever. We'll see if those things happen. I doubt it because it's going to take they always joke about it'll take an act of Congress. I'm talking about a true act of Congress, I think, to probably reverse that national debt. So we'll see if that even happens. Historically, tax rates right now, our rates are pretty darn low and extremely low compared to where they've been in history. I don't see that they're going to stay this low for the next 15 to 20 to 30 years. So we need to plan for that. So again, this is why I think that tax planning today maybe more valuable than ever. So also, if you plan today, you're going to protect your future generations. So we work with a lot of clients. We put them in a place. We start doing legacy planning. We do a lot of tax planning. So then there's not this massive, when they pass away, there's not massive taxes due, and they haven't passed on a giant tax burden to their heirs. And I think that's extremely important. So here's kind of our Hilton kind of true wealth approach is that we set up where we get to our clients with a true wealth strategy session, tax session, where we talk with you, kind of take a look at your taxes, get some of the details, and then basically get to what we call a tax saving number. And I think that's super important. We get people set up on kind of their own tax portals, and then we start focusing on setting up a plan as opposed to just doing, a one-off strategy or something like that. So we also kind of take a look at their risk in their portfolio, kind of give them a tax assessment associated with the risk that they're taking too, because often the more risk you take, the more tax burden that you could possibly have on your portfolio. And then we put a proposal together for them. So kind of the closing thing I would say is that if you want to invest and plan like the wealthiest, then you need to do the things that the wealthiest do. And I think it starts with a strategy, and not just in your investments. I mean, we're really talking about tax planning, because the biggest piece often of the wealthiest people in the world's portfolio, where they save the most, where they build most of their wealth, is from the tax planning that they've actually done. So that brings us to the end of today's episode of Hilton Tax and Wealth. If you want to learn more about the topics relating to building your wealth, tax planning, like we talked about today, cutting edge technology, family office services, we're here to help. And a huge thank you to you for tuning in. Be sure to follow us wherever you get your podcasts so you never miss an episode. If you found value in what you heard today, share it with someone who might benefit too. For more insights, resources, and to get a copy of our book, Hilton Wealth, How to Invest Like an American Dynasty, visit us at hiltonwealth.com. Thanks for joining us. Until next time, keep learning, keep growing, and keep building your true wealth.